Can you guys hear me? Fantastic. It's great when technology works. All right. We'll get started in a couple minutes. Give everybody a few more minutes to get in here. All right, Nunzio, should I get started? It's top of the hour here, 12 noon Eastern. Okay, everyone, welcome to the Boss Up Virtual Micro M&A Conference. I have the top of the 12 o'clock noon hour session. I believe everybody can see my slide deck here, and I'll get started. So I am going to cover the investor's perspective. Hopefully, the rest of the sessions will be pretty tactical for everybody. And as far as the investor's perspective goes, we'll try and get into the weeds here to the extent we can. We have about 45 minutes, and usually this chat takes about 30. So there should be a little bit of time left for discussion at the end. And I'll answer some questions via the chat, which I see here on my screen. I'm actually going to have to toggle over to my PowerPoint. So at about 12:30, I'll come back and we can go through the chat. What I want to do too is mention a friend of mine. His name is Tony Caprit. He's at a business called Blue Maple. He is a close friend of mine, a deal team member for my search fund boot camp, and a lot of the thoughts here today are shared with him and frankly kind of used from his presentation that he gives about the investor's perspective on small business M&A transactions. So quick summary on what we're going to cover. It's the high points. What do we as investors look for in searchers? Relatedly, what do we as investors look for in businesses and industries that searchers acquire in? And then what are we as investors looking for in an actual investment? And I like to use an analogy, or at least a couple of these analogies, to explain, what it is we are looking for as investors. The first one's the three-legged stool. We'll cover that in a minute. And the second one, relatedly, is the horse, the jockey, and the trainer. But first, a little bit about me. Besides my day job at Pursuing Capital, I've got two crazy kids and a beautiful wife. That's Andy, man. He's a big golfer. And my daughter, Ella, who's a soccer player, kind of to the point that we're all here trying to do our job while going home and taking care of our other job as family people. And that's a big part of what we do too. But why you guys are all here is sort of the investor's perspective. And my day job is to run Pursuing Capital, which is an investment company in small businesses. And about half of what we do is invest in searchers who are buying small businesses. Searchers are synonymous with entrepreneurs that are looking to become business owners through acquisition and not through starting up a small business. That's kind of why we're all here. And in that half of our business at Pursuant, we've invested in an assortment of small companies run by entrepreneurial operators across the US. Here's just a few to point out. Express Custom Trailers is a custom fabrication shop for cargo trailers here in Tampa Bay, Florida. System 6 is a accounting firm. Get Green NOI is a multifamily apartment complex services business. Splash Plumbing is synonymous with its name. It's a plumbing business out in California. And there's a host of other ones as well. So quickly about Pursuing Capital, just to be clear, we're not a fund. My friend Tony Capper, I mentioned at the beginning, he does have an actual fund. Instead, Pursuant's just a holding company of investments in small companies that we've made around the country. So we're only investing our own money. We're not investing other people's money. Makes it a little bit easier. The decision making is, frankly, comes all the way to me. So I get the benefit and the burden of making every call on every small business acquisition. So hopefully that'll be useful when I speak to sort of what my perspective is here. But as it relates to search funds and entrepreneurial acquisitions, the thesis around it is pretty simple. We're going to back really great operators and leaders to buy great businesses. And just as importantly, we're as investors not here to overstep. We want to help. We want to assist. We want to give our operators the benefit of all the repetitions, but not overstep into their world. And the reason we're doing this is obviously to make money. And over the past 30 years, the search fund asset class has returned north of 25% IRR, which is incredible. Now, some of the stats here are a little skewed. This comes mostly from the traditional search fund world, and we probably won't talk about the traditional versus self-funded world. But it's a good proxy for the general returns in small business buying. So I'll use a pretty simple analogy. I didn't come up with this, but I thought it was pretty useful. And that is the three-legged stool, right? And so without each of the three legs, the stool falls over. And when it comes to entrepreneurial acquisitions, the three legs are the business itself, the target company that the entrepreneur is looking to buy. It's the operator, him or herself, the entrepreneur, and it's the capital to support the transaction. And you can't really do a transaction, a small business purchase without all three. You need the business, you need the operator, you need the capital. Otherwise, it all falls apart. That being the case, I think, in my opinion, or at least in a lot of investors' perspectives, there's certainly a little bit of a priority in terms of which of those are more important. In my perspective, I would take the quality of the business as the number one consideration. I think the skills and characteristics of the operator come second, and then the capital is the last piece of the puzzle or leg on the stool. I've heard other investors that I'm close with and I respect a lot flip the first two, where they will start with the operator first, and that is their most important consideration. And the business will come second, and the capital is third. And I appreciate that perspective very much. In my opinion, and in the investments we've done, we've backed a lot of early entrepreneurs where maybe this is their first entrepreneurial venture after business school or after working in corporate America. And that's to say that they're somewhat of a untested operator. And so for us, what that means is we like for our entrepreneurs that we invest in to be in businesses that are almost foolproof or so high quality that it's really hard for them to screw it up. And that is just a better situation for our operators to be in. And so for that reason, I put the business first so that really all of our operators can be successful, and therefore they're second and capital is third. So let's go through each one. So obviously, we look very, very closely at the nature of the business that's being bought. The first and foremost consideration is consistent revenue, consistent profitability over a long-term track record. There is a phrase out there people have heard, enduring profitability, from the HBR guide to buying a small business. I think that's a great way to describe it. If there has been consistent revenue and profitability over a long period of time, it means there's something right there. I think the second consideration for us is that the consistent revenue and earnings were produced by a business that didn't necessarily rely on the owner. And in a lot of small business purchases, these small businesses are entirely dependent on the skills and the relationships of that owner who's been there for, in many cases, 30 years. And that dependence on the owner is a big red flag for us, because when that business gets transitioned to a relatively young entrepreneur who doesn't have experience in that industry, it's a huge risk. Another consideration is sort of generally lack of major red flags. We have a list of these. A simple one is customer concentration, but you can imagine there are many, many others. Vendor concentration, cyclicality, licensure risk, and all sorts of things that we tend to have our entrepreneurs screen for early on so that they don't get in pursuit of a business that has one or two or three of these red flags that make it a tougher deal to get done. And then finally, just such a simple business that an idiot can do it. And I kind of steal that jokingly from Warren Buffett, but in many ways it's true. If the business has consistent numbers, not dependent on the owner, and anybody can run it, it is a phenomenal opportunity from the investor's perspective to back an operator, to acquire it and make everybody a great financial outcome. Next up, the second leg on the stool for us is the operator. And I'll admit this is really hard to screen for. Uh, Sort of assessing an operator's skill ahead of them buying a company is incredibly hard. I don't actually know if we've gotten any better at it after we've done a whole assortment of investments. Maybe a little pattern recognition now has taught us that what matters most is their actual operating experience and not necessarily deal experience. A lot of investment banking, private equity types will come into the ETA and SMB space, and that makes them really good searchers. But in our experience, it doesn't make them always the best operators. And so, for example, that's why we find that military veterans who tend to know nothing about deals, but a ton about leadership and operations do really well in SMB. And then for me, big one is just integrity. And there's no threshold here. There's no real good way to test it, but absolute integrity. Um, a few others are elbow grease, which is my way of saying that in a small business, you have to be prepared to do every job because at a certain point, you might have to do every job. And so we're big believers that people who buy a small business and are successful, there is no job in the business they're afraid or too proud to do. And that probably dovetails with the next point. Just very gritty people do well in SMB. This is not a glamorous job, at least early on when you're transitioning and learning the business. And then lastly, we have found that a surprising number of entrepreneurs who buy small companies just lack some basic financial acumen that causes them to lose visibility and understanding of the performance of their own business. So, as an investor, we definitely try to source operators who have some basic financial acumen coming in. And then, sort of last but not least, is the capital leg of the stool. And I'll be frank when I say that this has kind of been the easiest piece of the puzzle for the last 5 or so years. Getting debt, raising investor equity, getting skin in the game from the seller. The capital part of the equation has not been the limiting factor. So, uh, uh, we kind of just gloss over this one generally. Plus, it's the investor's role. All right, so I'm going to move on to the second analogy, and it frankly doesn't differ all that much. It's the horse, the jockey, and the trainer analogy. And as I compare it to my last three-legged stool analogy, in this case, the business is the horse. It is the thing that's being ridden in order to take us to success. And the horse is ridden by the jockey, just like the operator runs the business. And then the third sort of piece of the puzzle is the investor, who in this case plays the role of trainer. And the trainer trains the jockey, who then rides the horse. And that analogy, again, I didn't come up with it, but the search fund, especially the traditional search fund world, uses this analogy a lot. And I think I believe in it. And again, it goes back to the same order of priority from my investor perspective, that it's the business or the horse that matters first and foremost. And if you are backing a quality horse, you can, in many cases, have an average jockey and still be very successful. And, as it relates to, my role here, we're the trainers. So my day-to-day job, again, is not to overstep or stick my nose into these businesses, but it's really to support and guide the operator and give the operator the benefit of the reps that I've had through the years of buying many small businesses. So let's take a little gander into the financial side of the investor's perspective. I think that's mostly why we're all here. We obviously all want to be entrepreneurs through acquisition of a small company, but we're doing that not just for independence of time, but independence of wealth. So Um, Again, thanks to my friend Tony Caprot, who provided these numbers that I like to use a lot too when I speak to searchers. But um, this is a really great example deal structure that I like to see. Uh, there's probably 1,000 reasons why this is a really great scenario, and that's not to say that slightly different scenarios don't work, and we'll cover that in the next slide. But as you can see, this is a sample transaction with a $6 million purchase price, 1.5 million of EBITDA, which implies a 4x EBITDA multiple. And we're going to talk about projected growth rates of 15% and 10% investor equity towards the $6 million purchase price. We really like the high leverage that the SBA provides. It's hard to see it now, but the way we describe it is it's the SBA bank debt that actually allows the searcher to own a majority of the business, or said another way, it's the bank debt that buys the searcher his or her equity. And that is the sort of life-changing opportunity here, because in literally every one of our SMB transactions, the entrepreneur controls the business. He or she owns a majority of the equity of the company. And really, the reason that exists is because of the high leverage. Essentially, 90% of the purchase price is acquired through bank loans and seller notes. And then I think an important sort of consideration here is the investors piece. And that is to say, if 90% of the purchase price, 90% of $6 million, so $5.4 million is coming from, one or two forms of debt, bank debt and seller note, well, then the rest of the money, 10%, 600K, needs to come from somewhere. And in our experience, it's either entirely coming from investors, or, a large share of that 600,000 would come from investors. And we like to see this metric called the gross equity step up, or investor equity step up, be somewhere in the, say, 1.5 to 2 range, all the way up to 3 times range. And that's really to say, if here the investor puts in 10% of the purchase price that you see on the fourth row, then how much of the equity will they receive in the business? And with a 2 times investor step up, if they put in 10% of the purchase price, they'll own 20% of the business. And that's probably the most important metric for investors, is that step up. And again, we think that even though there's no market for this, or strict guideline, sort of in the high ones to high twos is fair. And so in this case, what it would mean is if the investor group put in 10%, they'd walk away with somewhere between, high teens percentage ownership up to, say, 30% ownership. And we can go over that a little bit more in the Q&A. So I think a mistake that we see a lot of searchers make is using aggressive assumptions in their model. And so what that really means is that when investors look at a searcher's IRR and MOIC, IRR is internal rate of return, and MOIC is multiple on invested capital. Those are really metrics that investors use to figure out if an investment is going to return enough capital to them to be a worthwhile endeavor. If the searcher makes too aggressive of assumptions, you can artificially inflate these return metrics to make the investment look too good to us. And so from my perspective, when I go look at a deal structure and a searcher's assumptions, if they are way too rosy, way too aggressive, to me, that says this not only is unlikely to actually happen, but the searcher is either trying to fool herself or trying to fool me. And in either case, I'm usually a quick pass. I do want to say too, this base case calculator, I don't know if you can see it on my screen, but it's a Google Doc that is linked in the presentation. So when I share the presentation, you can just click on it and see the model for yourself and use it as a tool. It looks like you can't see it on my screen because I'm sharing the PowerPoint presentation, but when I share the presentation with everybody afterwards, you'll just be able to click on that base case calculator and it'll link to it. So back to these levers or assumptions that searchers can use to either make an investment look really good or be more conservative. I always sort of say there you can pull and push in either direction when structuring your deal, but you just generally need to paint a picture that's not too rosy because we've seen enough of these transactions to know that in almost every case, some things are not going to go according to plan. So, levers you should not pull is if you're buying a company at 4 times EBITDA, it's too aggressive to think that you're going to sell it for 5 times or 6 times EBITDA. You should always assume that your resale EBITDA multiple is the same as or even less than your purchase multiple. You can't control it. Another thing is assuming annual growth and EBITDA margins, assuming they're going to improve over the historical growth rates and margin rates is an aggressive assumption. And I will say I've seen this happen a lot where growth rates do improve and they are higher than they've been in the past, but it doesn't always happen. And it's too aggressive to assume that does. I think another hiccup we see searchers make a lot is to assume that, like the deal we're describing on the prior slide with $1.5 million of EBITDA, just because you have $1.5 million of EBITDA in the first year of your purchase, or it had $1.5 million the year before you bought it, assuming that you're going to have $1.5 million of EBITDA in year one does not mean you're going to have $1.5 million of capital to return to investors. And the reason is you're going to have a lot of uses of cash that your seller didn't have. So think about things like your debt service. If you're going to take out up to $5.4 million of loans, like you'd have on a $6 million purchase price, you're going to have a significant use of operational cash that goes towards principal and interest. So obviously you're not going to be able to return capital to investors if it's going to go to the bank. And I think the other one is there are just a lot of things that happen in the first year or two that are surprises. Investments that your seller didn't make because he or she was planning to sell the business. And so you have to make people that you need to hire because your seller didn't hire. And all of these are uses of capital that when searchers assume they're going to get into the business and have all this money to pay back their investors quickly, we tend to see that that takes a few more years than expected. So on the flip side, levers you should pull are really all about being conservative, right? Which means projecting your growth rates to match your historical performance, giving your equity step up, give the investors a higher equity step up because that does not change after close. And the larger the step up, the more margin for error you have in giving your investors the IRR and MOIC they've sought. And then preferred returns is the best way to think about it is it's almost like an interest rate on your investors' equity. And so the higher the interest rate, obviously the greater the IRR and MOIC. So you can pull those levers. And selfishly, they're to the investor's benefit. So I just wanted to point out a pitfall that we see all the time. And I will admit the first business I ever bought fit into this category. And it's a really glamorous idea that I want to advise from the investor's perspective to avoid at all costs. And that is turnarounds. And I think the reason that they catch a lot of buyers' attention is because you can get them cheaply. You might be able to buy them for 2 times EBITDA, or you can sort of see in your mind a very clear path for the business to grow much more quickly than it has in the past. And really this a turnaround is where revenue or profit has been in decline. And from my perspective, this is an absolute non-starter. And that is because if you think about a business being in decline, while the seller owns it, more than likely that means a seller who's been in that business for 10, 20, 30 years has not been able to turn the tide of revenue declines and EBITDA declines around. With all of their experience, relationships, all of that goodwill that you're not going to have. If they can't turn the business around, it's a pretty darn aggressive thought to think that you can turn it around. And I've made this mistake. It worked out. And I can't say I know why it worked out for us. I think hard work, a little bit of luck, but it's certainly a more risky proposition. And there is almost no exception to the fact that I'd rather see a searcher buy a business that's had super steady, almost I'd rather lower growth than negative growth. So something very steady, very predictable, very quote easy to get in the driver's seat of. That is a far better opportunity, a far better business for a business buyer, entrepreneurial searcher to acquire over a turnaround. And what is typically the case is when searchers catch a turnaround and look at it like a favorable opportunity, it's usually because their deal flow isn't good enough. And so they've been forced to look at a turnaround favorably. And whenever I get that opportunity presented to me from a searcher, I usually always have to advise them just to get their pipeline filled up with more deal flow. All right. So let's see. It's 12:30. I've got a few more slides left. I'll try and knock them out. So one thing that we've done at Pursuant is we've seen enough entrepreneurial buyers of small companies either struggle to raise the equity or have such fear over raising the equity that we've assembled this publicly available database. I've linked it here in the presentation so everybody can use it. And it's just a public list of every investor in a self-funded small company acquisition that we've ever seen that's consented to us putting a list together and sharing it so that anybody out there who feels like they're going to be uncomfortable raising money now has a reason to say, you know what, this might be possible. We're just trying to democratize the equity raising process. Again, this is, I and Pursuant don't stand behind the list. There's, put every disclaimer out there. This is just a resource, but we have seen it go to use where searchers have called on the folks on this list and raised money to buy their companies. So I do think it's a pretty useful resource for you guys. And that's it. Feel free to contact me anytime. That was a picture from a time when I had a lot of hair. So maybe this business is a little bit more stressful than I give off, but that's just a joke. Here's my contact info. Please send me a note if you have any questions. My email, you can find me on Twitter. I'm fairly active there. A little plug for our Search Fund Bootcamp that we host 4 times a year. And I think I stayed on time, so I'm going to switch over to the chat. And if you guys want to chat me any questions you might have, I'll answer them live and we can go for up to about another 20 minutes. Okay. Thanks, guys. Okay. So the first question is who guarantees the debt with the majority investor funded equity in the deal? Well, uh, let me just be clear that in the self-funded model, the entrepreneurial searcher guarantees the debt because they are using the SBA loan to supply the majority of the capital for the purchase. Um, so in self-funded, the searcher guarantees the debt. They typically don't invest a lot of equity, if any at all. Um, so they certainly have risk in the game by signing the PG on the bank loan. In the traditional search world, there tends not to be SBA debt, so there is no PG. Let's see. Corey asks, I've got a lot of active investors in my circle. How do I express to them they need to trust the operator in a lot of circumstances? So, I actually think this is something you need to do ahead of time as a searcher. I think too many searchers are too clinical about raising money. It's all about the dollars and cents. And in my uh, experience, searchers need to talk to their investors about sort of their philosophy of operations, their philosophy of communications, and how things are going to work after the fact. Um, I think that's just all about communication. That's usually the name of the game. Andrew, hey man. Andrew is asking, are step ups consistently 2x or is that based on deal size? So investor equity step ups are, there is no market for it. It's really whatever the searcher wants to propose to the investor. It's almost, think about it as just part of the term sheet you're going to offer us. And I'd say 2x is as close to market as exists today, but I've seen everything, down from 1.5 all the way up to 3. And I'd say that the lower the step up, the higher the preference needs to be. Um, but 2x is a good starting point. All right, let's see another one that came in. In the case of all of the equity coming from investors, how does the SBA see that? Good question. So I'd say case by case. I'm really only familiar with 3 or 4 SBA lenders in the search fund SMB buying space, and my experience is that a few of them are okay with a transaction where the searcher does not put in any money and the investors put in all of the money. And the others always want to see the searcher at least putting in a little bit. So that's kind of useless information. But what I would tell you is, as a small business buyer, if at all possible, try to be able to put in 1% of purchase price yourself. So if the purchase price is going to be $6 million, it's a really nice big deal. 60,000 would be kind of at a minimum how much you would be able to put in, and that's ideal. Doesn't mean you can't close on that business if you can't put in the 60K. All right. Let's see. Where can we get the link for listings? Well, I think in the presentation, I've got 2 links. I've got a link to the investor database, and I've got a link to the base case model. So you'll be able to see both of those. Paul's asking, could you talk a bit about good operations, communications, philosophies? Ooh, I hear this one all the time. Uh, because it's a loaded question, I'll try and keep it simple. And but I'll summarize it by saying I have never seen an operator over communicate with its investors ever. The mistake that is made over and over and over is lack of communication. When we bought our first business, I would send out a Friday afternoon email to my investor group every single Friday for the first 13 weeks we owned that company. And it's the same advice I give searchers today. All right, Alex is asking, I'm 2 to 3 years away from buying a company. I'm looking to move to an ops management role with an existing owner to gain some SMB experience. Do you have any thoughts and tips? I do. One of the best ways to get experience as a searcher CEO is to go work for a searcher CEO. So there are a lot of places like SearchFunder and Twitter where you can put yourself out there to become somebody who would go work in a small business that a searcher bought. And that is the absolute best way to do it. Couldn't agree more. Let's see. So, do you mind explaining the mechanics of how a searcher can offer a step up? Yep. So it's pretty simple. So if in my, let me go back. The example of this deal here, $6 million purchase price, and there's 10% equity injected. What that means is in dollars that of $6 million purchase price, 90% or $5.4 million would come from debt, which would really mean 5 million from the SBA, 400K from the seller note, and the rest of the money, 10%, 600,000 would come from investors. And so a step up really just means if there's a 2-time step up, that investors as a whole would receive 20% of the ownership in the company, even though they're only putting in 10% of the purchase price. So the mechanics or logistics are simply that in a 2-time step up scenario, when you go to propose the ownership table, you would grant a proposed 20% ownership to the group of people that provide the equity capital. And the remainder, the 80%, would go to you, the searcher. And that's why we're all here to do this. Okay. Regarding financial acumen, what do you see most lacking or most important for the searchers? Another loaded question. I guess the simple one is that basic accounting terminology and ability to read and comprehend the P&L and the balance sheet is surprisingly not understood well enough. I guess I've been a little disappointed by the number of searchers who want to buy a small company, but if handed financial statements, don't really know how to use them to interpret how well a business is doing and how to use those financials to guide their management. So, gosh, I wish I had like a more nuanced answer here, but I think the answer is just better accounting acumen, better ability to read P&L and balance sheet and to understand what those statements are telling you about the business. All right, Andrew Bishop is asking for investors. I know it's likely industry specific, but what's the average expected range or period of time for a return of their capital? Well, again, I think this is certainly a question you want to ask prospective investors before they invest in your business. But from my perspective, I'm looking at this as the long game. So if the searcher decides to hold for 10 years until the business is sold or there's a recapitalization event, I am all for that. I do believe that there should be some return of capital in the interim. So not the first 2 years. I really think the first 2 years, the searcher should use all of that excess profit to build up a war chest of cash in their accounts to pay down the bank debt, to pay down the seller debt, to invest in the business. And then starting in years 3, 4, 5, start returning a modest amount of capital to the investors. But that's just my take. Okay, Trey's asking, what are other great alternatives in finding and reaching out to investors other than LinkedIn and group meetings? Again, I'd say the typical resources that I've used, LinkedIn, Twitter. There's a community on Twitter, and I get that Twitter's kind of a challenging resource to use, hard to find who these folks are. But if you follow me and you sort of see the folks I'm following, that community is a really great resource. I think Search Funder is pretty good. And then, selfishly a plug for the investor database that we've had. You know what? Let's see if I can do this. Share. See if I can share. Here we go. This is what I mean by that database. So again, it's linked in the presentation that I'll share, but it's a database that we made nearly 70 investors that we've seen in these self-funded small business acquisitions, and name, company name, email, LinkedIn, and then some of the criteria they wanted us to share. So hopefully that's a good resource for everybody. Let me switch back. All right. So let's see who's up next. I've got a couple minutes here until I think Nunzio is going to cut me off. All right. So I referred to 2x as cheap when speaking about turnaround deal. What multiple range would you consider reasonable for a healthy, repeating, recurring revenue business? Great question. I would say, the market's probably changed a lot in the last 6 months. Maybe a year ago, I would have said, 4 to 5 times EBITDA is a reasonable EBITDA multiple for a high quality business doing anywhere between $600,000-$700,000 of EBITDA and $1.5 million of EBITDA. And I'd say that multiples have come down. So 3.5 to 4.5, but highly dependent on industry. And obviously recurring revenue is very desirable. So the more recurring revenue, the higher the multiple. Okay, we got a question about self-funded search in Canada. I'd say that I'm not super familiar. I know it exists, but I also know that the bank loan dynamic in Canada is a little different. And my whole perspective on self-funded search is really based on the fact that SBA loans exist. And that really informs our whole philosophy and structure on self-funded search. So I'd have to defer on that one, unfortunately. Okay, Kevin's asking, I've heard investors favoring entrepreneurs with operations experience. However, my experience has been that investors always defer back to the traditional. No, I disagree actually. I think in the traditional world, there certainly is always a tendency for the investor community to back people with really glamorous resumes. And those glamorous resumes tend to be of people that go into investment banking, private equity, consulting, but in self-funded SMB acquisitions, so they tend to be a little smaller, more entrepreneurial. I don't think I agree with that at all. There's a whole host of backgrounds of folks that get supported to buy companies. All right, let's see. So George is asking to stay below the SBA 20% owner, which I hear lenders look at. Yeah, it's a good question. So in my example here, where $600,000 or 10% of the $6 million purchase price would get put in by investors. To be clear, if that were one investor and they got a 2x step up, so they own 20% of the business, that single investor would have to sign a guarantee on the SBA debt, which is why that is almost always a non-starter for investors. And so in that case, the $600,000 of equity would likely get split up among 5 to 20 different folks, such that their pro rata ownership, their pro rata portion of the 20% ownership would be well below the 20%, even when you adjust for the preferred return impact. It's a bit of a loaded question. How do you adjust the stock percentage for the preferred return impact? What I would say as a rule of thumb to keep it simple, if an investor is going to own anything more than 15% of the company, then beware, the bank may ask for a PG. So as an investor, I always assume that my ownership can never be north of 15%. All right, I probably have enough time for a couple more. So Paul's asking, any experience in residential assisted living? I don't have any, unfortunately. I've looked at those in the past as more of a real estate play, even though they have an operational component. Oh, bridge loan financing 90 days or less. This is a tough one, I'd say. I've seen it happen recently a few times. It's pretty darn expensive. I mean, we're probably talking about mid-teens interest rate with, some equity kickers. So it's definitely expensive and painful. Search Funder is a great resource. Agree. Ed asked a good question. When buying from an owner operator, do you have a standard expectation of operator salary versus dividend paid out? Yeah, I think my take on operator salary is that no investor wants to see the searcher or the operator sort of living a glamorous life just because of salary. We'd rather that the searcher be generating wealth for himself or herself through the value of the equity. They're going to own most of it anyway. So to be transparent, kind of the 100 to 125, 150 range, it's probably the normal range for operator salary in these deals. Okay, Nunzio, I hear you. I've got 5 more minutes. So Chad asks, will the SBA allow you to have borrowed the down payment? No, absolutely not. The down payment or the equity injection has to be true equity. Cannot be a backdoor loan. Jarrett Graham, are there any states you would avoid purchasing a business? I don't think so. I don't know. I haven't avoided any on purpose. Hey, Michael Kreider, good to hear from you, man. Uh, he is asking, can you speak to any verticals that are more likely to have reoccurring revenue? Yeah, a lot of the home services do, like HVAC has maintenance contracts, pest control has recurring contracts. We're in a pond management business that has recurring contracts. Obviously, the big one is software. That's obviously an incredibly glamorous industry that's hard to buy into because of how expensive it is. So maybe I'd rephrase it, Michael, because reoccurring, truly contractually reoccurring revenue is so desirable, it tends to be incredibly expensive. Businesses with reoccurring revenue trade for very high EBITDA multiples. So I guess maybe I'll reframe your question. There are lots of verticals that have maybe repeating revenue that can be very valuable, but you can find a lot of those businesses for more fair prices. RT is asking, how and when do you broach target net working capital with the seller? Wow, this is a super loaded question. I have in the past delayed bringing up net working capital until after LOI. And then I've had enough deals die due to the net working capital negotiation after LOI that now I negotiate it in advance, always. Earlier is better, more communication, not less. Hey, Paul, 100 to $150,000 operator salary for $1.5 million EBITDA business. Yeah, I mean, I think that's right. I mean, it's kind of hard, in my opinion, for an entrepreneur to live on too much less. We don't want the entrepreneur, our partner, to be sort of suffering or struggling. So I don't really like for the operator's salary to necessarily depend on the size of the business. Size of the business should dictate, valuation of the equity or value of the equity. But that's just my preference. When in the process do you like to connect with searchers? I'm happy to do it pre-LOI. I think I'd rather wait until after LOI because then there's an actual live deal to talk about. But happy to do so beforehand. All right. Our value. Oh, hold on one sec. Our valuations for recurring revenue usually based on revenue versus EBITDA? I don't know. I don't look at a ton of recurring revenue businesses like software. It's just not my world. I'm more of a blue collar services investor where EBITDA is the metric for valuation still. Can a pre-existing EIDL that the seller has be assumed and utilized by a buyer as part of the SBA loan? I don't think so. I thought that just like PPP, that needed to be wiped off the balance sheet at close, but I'm not super familiar with the EIDL as opposed to PPP. How much can you learn from a P&L without really getting deep into it with the owner? Yeah, you're speaking to the choir. You definitely want the color commentary from the seller. All right, following up on the networking capital question. Yeah, I think so. What's true in SMB is that in almost every case, when you say networking capital, the seller's eyes are going to glaze over and they're not really going to understand what you mean. What tends to work better is to describe what those are, which is really to say, are you as buyer are you getting the receivables? Are you getting the inventory? And are you assuming the payables? And just keep it very simple. So you can at least agree on methodology, even though you don't get to the amounts of those items until after LOI. Okay, guys, I think we're at the end of the time here. It's 12:55. You should probably move over to the next session. I hope that was helpful. I don't know how we're going to do it, but I'll give Nunzio the link to the presentation so he can share it. And I'll let you guys jump over to the next one. Good luck. Welcome, guys. Thanks for the nice notes. Okay, guys, have a great day. I'm gonna take off. I just dropped my Twitter here if anybody wants to reach out there, and I'll talk to you all soon.